What are the pros and cons of liquidity for shareholders in the pre-IPO market? First off, liquidity. You're actually going to get cash in exchange for your shares. You've converted an illiquid asset into a liquid one, which is cash. So now you can diversify, you have a bit more control over your net worth. So that kind of falls into a bit of risk management too, right? Instead of having 100% of your net worth all tied up in one company, you've diversified down to 80% or 70 or even 50%. So that also has some marquee benefits. For companies, there's a big benefit on liquidity in the sense that employees and ex-employees always love it if they can convert something into cash. So having that flexibility and the ability to get liquidity for their shares can translate into a great retention mechanism for companies. And we've seen that kind of time and time throughout. Lastly, you're bringing forward the potential income or revenue you might have gotten from selling your shares once a company goes public. You may have had to wait years to get liquidity for your shares, and instead you're getting it now, right? So bringing that forward is obviously of large benefit to you as well. Of course, trading in the pre-IPO market and selling in the pre-IPO market doesn't come without some potential cons or some things to look out for. A couple of things could happen. One is you may sell your shares at a price that's lower than an ultimate valuation the company gets in the public markets or if it gets acquired, right? So you might have missed out on some of the upside. Some other cons are that this process is a little bit slower and takes a bit more time, right? So you may have to be a bit more involved in getting a secondary transaction done than, say, waiting for the company to go public and just clicking to sell in your brokerage account. Another thing involved is that there are more fees and costs involved. Each platform may have some type of fee structure they have in the event that you sell your shares, and it's likely higher than what you would have had to pay to sell your shares in your public brokerage account, which is typically zero these days. And sometimes companies may charge you a fee as well, maybe a transfer fee, or they'll require a legal opinion that you'll have to furnish yourself for some amount of money. There's also tax implications. So let's just say in the private markets, you exercise your stock options and then you very quickly sell the shares that you received as part of the exercise through a secondary sale. You may have to pay short-term capital gains, which are typically is the same tax rate as your income tax rate. That can be as high as 40, 45% in some states like California. However, if you had exercised those stock options and then held on to the shares, for a year or 2 years or so, you may have been eligible for long-term capital gains, which is a rate that can be closer to 15 to 20%. So there are tax implications to be aware of. There's also the alternative minimum tax that can come into play for your stock options, which is for another time. This is really just to highlight that there are some things to be aware of from a tax perspective, amongst other areas, before selling your shares. Of course, as a reminder, this is not tax or legal advice. We strongly advise that you do speak to a professional accountant or lawyer to determine your course of action here. Again, this is not tax or financial advice or legal advice.